Please welcome your moderator, Director of the McKinsey Global Institute, Jonathan Woetzel.
Thank you. That was the voice of God there. Welcome. If you lived here, you'd be home by now. I think I saw this every day, as I was driving home, naturally being in LA from downtown, heading towards the valley for 30 years. And so a very appropriate title for today's conversation about what is the state of housing here and where are we? We have a panel here who literally covers the entire ecosystem from government to academia to finance to development. And people who have lived this situation for far longer than I've been around. I want to introduce the topic with just a few words on the facts as we've seen them today. We've put out a report, it's in the front there, on the housing situation. In a nutshell, the news is not good. California ranks 49 out of 50th states in housing units per capita. This has a real housing cost. It's a cost to people, a $50 billion gap to individuals. It's $140 billion of lost economic output. And it's everybody. It's not just low income. We think 50% of average middle income households cannot afford their housing. So this is no longer an isolated issue. It's across the state. Every county has it, and every income segment has it. So here's where we are. What can we do? Is there a silver bullet? Can we find simple solutions for this? Our estimate is that it's more of a complex issue, that it's going to take an all of above the approach, but there are opportunities and a solution is possible. So with that as an introduction, I'm going to start by turning to you, Carol, if we could give a bit more history and context, and also some of your thoughts on innovation from the Turner Center of Innovation.
Sure, thank you. It's great to be here. Maybe could we pull up slide 8, please? I just wanted to start this by putting a finer point on some of what Jonathan just said relative to where we are. And this is just for California. This is a slide that shows single-family and multifamily permits starting back in 2000 to 2014. And then it shows population growth. So you can see we've got a big white area there in the middle, which is all those people who need places to live, but we're not permitting on an annual basis enough housing to actually get there. So there's a lack of supply is a major problem. The other thing you'll see from this slide is those gray bars were all single-family homes. The dark blue is multifamily. So you can see that when you start to think about this in California terms, in terms of how we deal with our climate change goals, we are trying to shift more to compact kinds of development and density. And you can see that's starting to happen actually in 14 and 15 with more dark blue than gray, except we're at a clearly very, very reduced amount of production. And so that creates pressure on prices and such, as Jonathan mentioned. If you can go to the next slide, 9, I just want to say it's not just about lack of supply. It is also that we have had stagnant and declining incomes in the state. So we have not had the kind of wage growth that we need to support anywhere close to the kind of price appreciation that we've had. Now that's starting to turn around in 2014 and I'm sure in 2015, but the home prices, because of the lack of supply, and rents because of the lack of supply, are getting farther and farther away, even as we start to get a little more wage growth into the system. So those are two of my finer points on the problems. On the solutions, clearly one of the solutions is that we need to get much more supply online much more quickly. And how do we do that? And I'm going to let our politician here talk a little bit about some activities at the state level, and I'm happy to then chime in, but I do think we've got to deal with the permitting process and the cost that adds in time and uncertainty to getting supply online. So that's certainly one area that I think we should explore more, how we do that at both the state and the local level. The other thing, and I'm sure one of our panelists is going to want to speak to this, is just the actual cost of construction, land, construction costs, permitting fees, impact fees, mitigation fees, exactions, whatever you want to call them. Add all those things up, have gone up astronomically, particularly in the past few years. And we've got to attack that, I think, through a variety of innovations, including modular off-site construction, for example, to try to start to get at lowering costs. So last thing I would say, back to this slide on income, we lost a lot of money in this state when we lost redevelopment funding. And for very vulnerable, for those very low income residents, we can add all the supply we want. We're not going to get there unless we actually also have some kind of income support or subsidy to reach down to the very lowest level of income. But we should be trying to get the market to deal with the middle and the upper income so that they are putting less pressure on the existing housing stock. So that's in sum the way I would see it, and I'm happy to engage in any of those further kinds of conversations.
Scott, if I can turn to you, I mean, we just heard opportunities to improve, challenges on the cost side dramatically. How do you see it? I mean, is this simply a reflection that things are now just too expensive?
So I think that's a huge part of the issue, and we were talking earlier, Carol and I. So if I go back to coming out of the last cycle and through the recession, I said to Carol, I would be able in 2009 and 2010 to build a 3-story townhome for $57 a square foot. It's a great price. Today, that townhome is costing me $85 a square foot. In the peak of the last cycle, so if we go to 05, 06, that number was around 81, 82. You couple that with land prices. So we have a piece of property, our office is Seal Beach, we build all throughout LA, true core LA, in North Orange County. We developed a piece of property in Los Alamitos, right above Seal Beach. In 2011, we paid $34 a foot for that land. Today, that same parcel, we're buying the piece next door, is $102. So you take $85 a foot to build it, you take $102 for the land, and what happens? We did less deals this year than we've done at any time in this cycle. And for us, we try and stay Southern California affordable, so we try and keep average price points at $500,000. That is a very difficult assignment in today's world where costs have gone up in all areas. And as I was mentioning to Carol, it's not just the build side, it's the professional fees, the government fees. And at the end of the day, we want to be affordable, but we are also a for-profit developer. And so if we can't see our returns in this market, and we'll also get into the other issues of the time it takes to entitle, and everything we do is an entitlement. And you have to be a little bit of a visionary or have a crystal ball or just cross your fingers, because when you start entitlements today, my deals today, I'm looking for deliveries now in 2019, 2020, 2021. So although I feel very good in the market, 16's been a great year, 17 will be a great year, there's some unknowns out there. So there's a lot of concern from the development community and the capital community, which you can probably touch on as well, with what's happening in the market. And the biggest issue right now is affordability, the biggest issue. And affordability is a much greater issue in this cycle than it ever was in the last cycle.
How does it look from the financing side? Are you seeing similar stress?
The answer is absolutely. Scott touched on affordability, and I was actually just at the Mortgage Bankers Association conference in Boston, and there's a lot of talk about affordability here in California, particularly in the Bay Area. And, there are still a lot of memories with respect to the last crisis. And so, the lending community is, wanting to make sure that when we make loans, they're sustainable. Certainly the lesson from the last crisis is you need to make a mortgage, you need to make sure that that mortgage is long-term and sustainable, and that means you need to be lending to the right borrowers and the right properties. The other issue that we face in the lending community is we need to make sure that the reaction from policymakers when you have a bad situation is consistent with the situation. Everybody is aware of the issues lately with one of our large peers here in California, and we want to make sure that, when somebody does something bad, that action, the response is measured, and that it's, not necessarily blown out of proportion. What we've seen in some situations, particularly in the mortgage side, is, there's sort of broad punishment going across even the sort of the good actors, and it has a depressing effect on lending activity. And often that lending activity, the depressing activity, is disproportionately borne by the underserved, minority groups and low to moderate income folks. And so we need to make sure that policymakers, do the right things, hold companies accountable, protect consumers, but that the punishment fits the crime and that, folks don't overreact to situations.
Yeah, well, clearly. Well, speaking on the policy side then, Richard, you've a stressed developer community, a finance community that's concerned about the availability of credit and sort of how that's playing out in the marketplace. Carol's highlighted both the supply and the demand side dynamic here. As someone who's sort of in the firing line, so to speak, of the community about how to deliver this, what have you seen as being some of the things that have worked over the last couple of years, and what are some of the things to be worked on going forward?
Well, there's a multitude of issues to work on, and the report really, I think, very well identifies many of those. We've gotten started on some of them, but there's really, I think, just an emerging awareness of the depth of the housing crisis in Sacramento. That's partly because our constituents see the housing crisis as something they're upset about because the cost of rents and the cost of for purchase property is out of sight for so many Californians. At the same time, they don't want it. The solution, at least some of the solutions that lie in increasing supply, are something that many constituents are also opposed to. And the connectivity between those two issues is not really seen that clearly, I think, by most in the community. That's to some degree a failure of leadership. We have to do a better job educating the public on the connectivity between these issues. But it's very, very politically difficult, because when it comes to development in many parts of the state, it's typically coastal California. I represent the west side, Santa Monica, Beverly Hills, Hollywood. In my district, it's everywhere in the district, where when you say we want to build more housing, people say, well, we don't want more of that because it's going to increase traffic. So bridging the gap between that traffic problem that people see and building housing is one of the keys that one of the important things that we really face here. I see the housing crisis as a crisis that affects the quality of life of the majority of Californians. As you reach down into lower incomes, it affects that quality of life even more dramatically. And so this is an issue that is begging for solution, but it's one that is fraught with political difficulty.
Can I chime in on this? And really want to thank the Assemblyman for his leadership in Sacramento on some of these issues, including just getting the accessory dwelling unit bill passed and signed by the governor, which seems like a little thing, adding studios or adding on to the back of a house to increase supply.
Even I thought it was a little thing, and then I read the report, and it says up to 800,000 units.
Put up slide 6, if you would, just so we have a number around it.
So it seems like a little thing on the one hand, but on the other hand, it's a big improvement, and you took leadership on that. And by the way, I always like to say our research shows that something like 65 or 70% of most people live in single-family detached homes, and those single-family detached homes aren't going away. So finding ways to increase intensity of use in those single-family neighborhoods is part of the solution. So thank you for that. On the expediting getting more supply when you have a situation where, not in my backyard, who is motivated to add to the supply in their community. 2 points that I would make that make me hopeful. It's going to sound negative when I start, but it will get hopeful, which is this. Something like 81% in the Bay Area homeowners say they're satisfied with their housing. 86% of renters are not. The problem is that renters don't vote in the same numbers as homeowners. One of the things that makes me hopeful is I am starting to see a sea change amongst my students, amongst the millennial generation saying, you know what, you guys have all screwed it up for us, and we want ours. And we want to be able to own a home. We want to be able to rent something affordable. And I think we're starting to see a shift. It's slow, and I'm interested in your reaction. But I think we're starting to see a shift of people who those who don't have are starting to be in a position to want their voices heard.
Well, we'll see in a couple of weeks how millennials turn out for the election. Traditionally, they have not been high propensity voters, and it does have an impact, and they are amongst the groups who are most affected by the housing crisis.
Absolutely.
It's their quality of life that's affected as much as anyone else's.
Maybe I just actually bring you also back in here, Scott. I mean, as a builder, do you see this resistance? And maybe you were having that great story about how you can have a factory on a development project on one side of a city, another side of a city, a completely different conversation.
Absolutely, and we do see the resistance. I saw a great slide that said everybody in California wants everyone else to use public transportation, which couldn't be more true. It's the same thing for affordable. They all want it in everybody else's neighborhood. The constituents in these cities are in control today. They weren't a few years back. They're more organized than ever. We acquired the Sriracha hot sauce plant in the city of San Gabriel before they moved to Irwindale. Part of that factory sat in Rosemead. There was a channel that bisected the building, and the building actually carried over the channel. It was a 95,000 square foot building, single level. We go into San Gabriel, incredible. They want us there. They love what we're doing. We're doing townhomes. We're bringing some density into an area that has public storage on one side, a channel, a train. They were like, we can't believe you're coming here. And I'll get to the end of what happened when we opened as well. The other part of the building in Rosemead, they said if one person comes out against this project, you will not have our support. That's what they told us. So one person came out, and we said, okay. And what we ended up doing, I was telling Jonathan, we hired a structural engineer, and we just cut the building. And we left the Rosemead part of the building alone and sold it to an industrial user, and we built 88 townhomes in the city of San Gabriel. Those townhomes were priced in the 4s to the high 6s. We sold 88 townhomes in 7-8 months. I probably could have sold another 200 or 300 in that city. We got full entitlement through CEQA and everything in 10 months due to city support. In today's world, there are numerous cities that we will not even consider building in. Because either they don't support development, and they all say they do. They all say they want affordable. But when you truly get into it, they really don't. And you had some great, Jonathan's report is absolutely excellent at hitting on the key issues, and you talked about RENA.
Yeah.
I think that's a joke to a lot of cities. There's no enforcement to it.
Yeah.
And so they all want to say they're complying, but what are they complying to, and what are the consequences when you don't comply? And cities that work well and understand affordable, we just did affordable in Pasadena. They get it. And by the way, Pasadena is very difficult to entitle in, but if you understand and they have a playbook, if you follow the playbook, you get your entitlements. I think Santa Monica has that. Huntington Beach, La Habra, they understand inclusionary. They understand that there's a trade-off for the affordables. There's just not enough of it. And I think the one key thing in your report, it shows all these available parcels to build on. There is plenty of land in the urban core. It's underutilized property. There's some vacant. I think we've knocked down 8 churches, believe it or not, in the last 7 years, including Highland Park. We just did a piece of his church. So there's a lot of underutilized property. The problem is it's the entitlement time frame and it's the support. And I'd mentioned to Jonathan, even Highland Park, which is pretty contentious, and the gentrification term, I don't know, maybe we've all been gentrified. I'm not even sure what that means anymore. And it's something that's used against developers in many instances. So we got full approval on this project, and a apartment owner who was 100 yards from us decided to appeal the project. And why was he appealing the project? Because he wanted us to write him a check. Not a good reason to appeal a project. To the credit of the city of LA, they denied that appeal. But the concern to a developer is, we now own this project, we've invested millions of dollars, and we could be appealed, which could hold our project up for many, many months, if not years. I just want to make one last comment on the NIMBYism. You've touched a chord here. In California, we like to use the term buy right. My last buy right was a buy very wrong, and that was in the city of Orange. And this shows you the difficulty. It was a true buy right development. The zoning was in place. We had a neighbor that turned up who was not even a homeowner, was the girlfriend of a homeowner, and she went to battle with us. And she cost us 2 years.
Wow.
2 years on an entitlement that was originally 58 two-story townhomes. We will now, and hopefully it's a good thing, have the only project in Orange County or LA that are single-story townhomes. I didn't even know single-story townhomes existed, but now I will be building them in the city of Orange. And we went from the 50-plus units, we're now a 37-unit project. But that's what happens in today's environment.
The other thing, if I might add,
Yeah, please.
thank you for the compliment about Santa Monica.
That's a great, incredible city.
I'm not so sure it's deserved at this point. But the only housing that's being built as a result of this dynamic is at the high end. So then you see the side effect of that is that the public looks at it and says, well, the only thing that's getting built is high end, and that's not helping the majority of people. So there's another reason why we should be against all this development that's going on.
That's absolutely right.
I have the dubious distinction in my district of being host to both the LOVE initiative, that is strongly anti-development initiative that will be on the ballot and decided in 2 weeks, and also the Neighborhood Integrity Initiative in Los Angeles that emanates out of Hollywood and will be on the Los Angeles ballot in March. It's a bad environment out there right now, but the other dynamic that I don't think we're seeing statistics on is the projects, and you touched on it, Scott, the projects that are not getting built, that are going commercial as opposed to, because it's easier to get entitlements there, which is bizarre, since commercial development is historically the thing that the public hates the most. But I can point to about 1,000 housing units in Santa Monica that are not being built because developers, in one case, a project was ended by the city council. It was killed by the city council when it was about to go to a ballot initiative. And then 2 other that had significant community opposition. One, I don't even think I should call it significant. One had 1 neighborhood group meeting, and the developer, it was 150 units, roughly 150 units, about a block and a half from my house, in a great site for housing. And the developer said, I don't need this, sold the project to a commercial real estate developer, and a Whole Foods 360 market is going in on that site. That's the only thing that'll be on that site that is going to drive PM traffic at an intersection that is already horrible and make things significantly worse. So we lost a housing opportunity and make things worse at the same time.
Well, but Richard, don't you think with Measure J, so Measure J, you're now telling me if I rezone a property to residential, I am now going to use union, so I'm going to push my costs up 35%, and I'm now going to be required to have an affordable component. So people always say, well, what is that going to do to my business? I'm not a landowner. I'm a developer, so I buy your land. You are most likely not going to sell your property to me because the highest and best use from a value standpoint will remain as the current use, that whether it's industrial, commercial, retail. So I think it's very interesting. Again, we talk about all these initiatives and things we want to do, and Jonathan highlighted these. I mean, there are some pretty simple solutions. It just needs the backing of everybody to say this is what we're willing to accept.
But before we go to that, I actually wanted to check, Aaron, you have a bit of a statewide view. I mean, do you see this picture of patchwork, some communities that are more enabled and are doing things faster than others to build housing, and some which are simply, you don't have much hope for the opportunity there?
Well, I would say as a lender, we're a little bit removed from that. What we see are broad themes in expensive areas and then broad themes in affordable areas. And so the issues in Los Angeles, San Francisco, San Diego, Orange County, the specifics are a little bit different, but those are, quite honestly, there are at least pockets of wealthier people living there, and they have more ability to, direct the process. In the middle parts of the state, where things are a little bit more affordable, you've seen, it's a little bit more of a blue-collar type of a workforce, and you certainly see, Fresno and those types of areas, things seem to be a little bit more flexible and a little bit easier to coordinate. And so it doesn't seem to be, necessarily, Northern versus Southern California, but really has to do with higher density areas versus kind of more rural and suburban areas. And if we could figure out a way to, protect the individuals in the higher density areas, but be as nimble as some of the more, rural and, suburban areas, I think that would be a big benefit.
Learn from Fresno.
That's right.
Yeah, well, I was say a couple things. One, we talk about, where we think we need the supply, where the jobs are, closer to the jobs, and yet those are the most difficult places to actually add to the supply. And lending is difficult at an affordable level in those places because you don't have a supply that's affordable. One of the things that you mentioned in your report, and we did a deep dive on this, is, this is not, the way we do land use in California is not normal. And people have come to think of it as normal, but it is not normal. It is not typical, actually, going across the country and across the world. In most parts of the world, by the way, development is not approved at the local level. Just think about it. Why should just the people who live there now be the ones who are making the decisions and driving the process? And you may think a little bit differently as a politician, but one of the things that you put in your report that we've done some work on is places where states take a stronger role in setting the table for what localities need to do and how they need to do it. And we're really hands-off in California. Yes, we have the regional housing needs allocation. You have to plan. You have to plan for so many units in so many places. You don't actually get graded on whether you actually produce them at the local level. You don't get funds withheld if you don't produce them, right? So we could, at the state level, have a much stronger state framework that changes this local dynamic. So that's one. The other solution that nobody wants to talk about, but I'm interested in your view on the Whole Foods situation is, commercial...
Great food.
Great food. Whole paycheck, as we say. Was that driven partly by the fact that the localities get the sales tax from commercial? So there's this idea that somehow housing doesn't pay. Commercial pays, but housing doesn't pay its fair share, its fair way of taxes, which is why it needs to be feed to death, at the beginning. So again, changing that dynamic. Can we have regional sales tax sharing? Can we do some things, even shy of touching the third rail of Prop 13 and say, how do we change the dynamic that incentivizes communities to want to fulfill an obligation to provide some housing and not just always do the thing that is going to maybe generate more traffic, but it's going to generate a lot more money for them as well.
To you, I mean, is that...
the dynamic is driven by the fact that developers have investors that they're responsible to, and when in an up market, when property values are increasing and the value of projects are increasing, and the developer sees that it's going to take an inordinate amount of time to get a project approved and can make more money by simply selling it and letting somebody else take on that risk. That's what happened at Whole Foods. It was a very simple calculation where the developer said, life's too short and I can take the profit out now.
They made that calculation because the environment was such that they knew it was going to be difficult to get housing done. If you changed that fact,
yes,
right, you would have changed the calculus for the developer.
Yes, and that's going to take some doing, and I do think that the leadership needs to be at the state level. I had 3 housing bills in the last session. Only 2 of them made it to the governor's desk and were signed. And the third one was what became the buy right proposal that the governor made. He changed it not a little bit, he changed it a lot. And that's a whole other story. But the major opposition to particularly the ADU unit bill came from local government. The California League of Cities, not listening to all of its cities, but many of its cities are offended at the notion that we would take local control away from our communities. We have nurtured that concept of local control for decades now, and we have to decide in California what our priorities are. And it is very, very clear that for a majority of Californians who live in most of our major cities, a policy change, a priority change needs to take place when it comes to housing. I think we're on the verge of seeing that happen, but it takes a lot of political capital to see something like that change.
But, we have a little bit of time, so if I can keep pushing on that. The RENA, for example, was brought up here as being an example of where there's a commitment, it's planned for, but there's no enforcement, there's no real pressure on a city to do it, and so it doesn't, in many cases, get done. Is that the kind of thing where you could actually see a state or regional kind of governance structure that creates an incentive, or at least a dynamic that says, why isn't this happening at the local level, and you guys should do it?
I frankly haven't focused a lot of attention on that specific issue. From my time in local government, I was on the Santa Monica City Council for 14 years. We routinely did battle over RENA, and we were building housing, particularly affordable housing. But there was a constant battle over whether or not we were achieving our RENA numbers or not, and the city was able to win most of those battles simply by stretching them out forever.
So the state was sort of, this is the target, but you were actually able, sort of showing that there were some barriers in the marketplace.
Yeah, and we also felt that we were being unfairly targeted because we were actually trying to do the right thing. And there are communities, particularly on the issue of affordable housing, I suppose I don't need to name them in this room, but we know who they are, who say, we don't need, we're not a community that's about affordable housing, so we don't have to build it. And they get away with it. They build nothing and get away with it.
So this goes back to the RENA issue, though. You can do a housing element, you can plan for it, you can zone for it, but there is not enough, there isn't any teeth to it at the state level to actually, so what happens if you don't do it? You can just continue to kind of defy, you don't have a approved housing element, but it doesn't really affect you very much as a community. And I think you could change that dynamic, and it's a incentive and stick kind of idea, which is, maybe this expedited processing in urban infill areas, where you kind of bypass the local controls, maybe that only happens, maybe you get a pass if you're meeting all your housing needs allocation, right? Then maybe you get your local control back. And so is there some way to pair, actual teeth to production? And, I think there are, but political will is challenging.
Which
like that.
it seems like it's more, the political will is more available in Fresno than it is in the denser, higher income areas, which is challenging. So, I mean, but I don't know, does this problem ultimately, if you will, solve itself? Because ultimately the jobs and the population, I think the fastest growing part of California is inland, is central. That's where most of the population growth is possibly.
One of the things we talked about, and I think might be changing a little bit, is we talked about traffic. And Scott, you said everybody else should be taking public transportation. I'm not sure that's true with millennials anymore. You hear them, they've embraced Uber and Lyft. And our office is in Pasadena, and everybody who works east of our office in more affordable areas, they all take the train in, and they all love it because they whip out their iPad, they pay bills, and what have you. And so it does seem like there's a little bit of room for optimism, on the whole issue of traffic. I think what's going to be really interesting to see here in Los Angeles is what's going to happen when the Rams stadium is built. They're talking about potentially extending the train so it will go all the way down there. And yes, it is on the flight path of LAX, but I think that, you've seen a lot of exciting things happen here in downtown Los Angeles with LA Live once the Staples Center thing got some momentum. So I do think there's some reason for optimism that you may see these hotspots built up around urban hubs, not necessarily around transportation hubs, not necessarily just because they're on a train line, but maybe because they're on a train line and there's something interesting and kind of sexy about them as places to live. And so I'm pretty hopeful that the Rams Stadium may be sort of another model following off of what's happened here in downtown LA. And I really can't emphasize enough, when I talk to millennials, they're not all that interested in having a car. They're used to using Uber and Lyft. And, 20 years ago, public transportation here in Los Angeles was a little bit of a joke, but people are actually starting to use it a little bit.
Yeah, well, I mean, there's that potential. I hope that the build-out will actually reshape LA, maybe not like the freeways to the new rail. But yeah, Scott.
Yeah, I just wanted to comment on
the. Also.
What was that, John?
I was asking, put up slide 6.
So we were one of the largest transit developers in the state for many years. And in Northern California, as Carol can attest to, it works very well in comparison to Southern California, particularly in Orange County. We were in the city of Orange, Fullerton, Buena Park at these train stops, and to me it was just an amenity at the end of the day, as much as we'd like to think that people are going to use the train to get to jobs. Big change in this cycle. And so what we've now seen near the office here in Pasadena, so we were right off a lake. We just finished up a project. You could get on the Gold Line and get to downtown. People are using the transit. Highland Park, we're in between two stations. We're right at Figueroa and 50th. We're doing Lamert Park at Crenshaw. We love transit. We like transit to be used. This time I'm seeing it used. In some instances, the millennials can't afford cars, and it gives them the ability to, whether it is Uber, Lyft, or the train, it's a huge advantage. But the millennials, and you look at the power of the millennials, which many compare to the boomers in scale, that's our buyer. So I love when people say the millennials don't want to buy homes. Literally, I would have 60% of my homes wouldn't be bought if that were true. So we have plenty of millennials that want to buy. Many are assisted by their parents today. But the big challenge I think that we face, along with the affordability and the land availability, is where people want to live today. Where do they want to live? Yes, there may be lots of people in the central part of the state and inland, but more people want to move closer to the coast. And we have really seen that play out this cycle. And there's not enough housing, and having built thousands and thousands of homes in the Inland Valley in my KB days, the anomaly of the last cycle is anybody could get a loan. And so we would have buyers drive out 2 hours one way, 2 hours the other way. They'd have $150,000 in equity. They hadn't even closed the house yet. Many would then get on a plane, and I've talked about this before. They'd go to Phoenix, Vegas. They'd buy another 2 or 3 homes. They were trading homes like equities. Thank God that does not exist anymore. Okay, the loan environment is very good. I know Wells doesn't have the greatest name right now, but they've done the majority of our loans. And the big difference is at the depths of the downturn, a Wells would have done 99% of our loans. Today they're only doing 50 because the market's freeing up. The market is freeing up in a good way on the underwriting, in a very healthy way. There is no zero down, but you have 3%, 3.5% down. It's a very healthy mortgage, and you know what I love about it is people are staying in their houses. There is a lot less mobility in this market. People want neighborhoods today, but they are not going in. The Inland Empire is not coming back. It's just not. Look at where we are in the cycle. Yeah. Look at where the pricing is along the coast compared to, and there's plenty of people that are always going to live in the Inland Empire, but you got to take out all the people that were going out there for investment opportunity. And where are the jobs? And Carol talks about wages. You need wages, you need jobs. Our whole business plan is based on wages, jobs, and where people want to live, and they want to live in neighborhoods. Santa Monica is a great neighborhood. It is truly a neighborhood. Highland Park is a neighborhood. Leimert Park is a neighborhood. And you know, the world has changed in the cycle. And if you don't follow the millennials and you don't believe in them, in our business, you are going to be in big trouble.
That's an optimistic note. I wanted to put this up just because, just again, to ask people, sort of, is there one form which will make a difference? Obviously, we don't think so. Or is there any of this which is impossible? I mean, so we have vacant land. There's land that's for whatever reason it hasn't been used. It's already zoned. We have the transit conversation. You just talked about it. So transit hubs and densifying around that. We've got underutilized land. We got ADUs. We have single families that adding on an additional unit. Underutilized, maybe that's sort of a subset of vacant. Sort of there's something on it, but it's not built out to where it needs to be. And then finally, we've got affordable single-family housing. I mean, there's still plenty of areas which could build adjacent small lot, single-family within 5 miles of a transit stop near some kind of development. So these are all possible ways to close that gap. And let me phrase it positively. Is any of that impossible?
I think some of it is economically right now. I mean, so you may have the land, you may even have theoretically the zoning capacity. I mean, I'll just take, I know it's a Southern California crowd, but downtown Richmond, California has zoned everything for 4- and 5-story, higher density. It's part of the sustainable communities area, but economically that community can't sustain rents at, $3.50 a square foot, which is what you need to be able to build that product, right? So you've got a mismatch between what it costs to build and the modest profit that you need to make, right, to incentivize you to build it, and the rents that people in that area can afford. And the same thing, happens on the lending side for home ownership for these products. So I think.
Carol, have you taken the BART to that stop at Richmond?
You could.
No, have you taken it?
Yeah.
So that's our project.
Yeah.
So we built that project. That project, it's called Willow Walk. It was 130 units right at the end of the stop. That was done in maybe 05, 06. We can't recreate it.
Exactly.
We actually walked away from the property next door, and we cannot build on it. It's a great point.
Exactly. And I had my students doing a development studio on those lots.
Yep.
That are all kinds of vacant lots in downtown Richmond, next to a BART station. You can't make it work economically. Same thing's happening Oakland. Everybody's talking about Oakland and this huge resurgence. You can't build. I think there's 1 or 2 folks that are trying to do high rises in Oakland, marginally feasible in the best locations on the lake in Oakland. Nowhere else, can you do a high rise in Oakland. So.
And that's the cost of construction?
It's the cost of construction, it's the cost of the fees, it's the cost of the entitlements, it's the cost of the uncertainty. You add up all those costs, and there isn't a developer that will build unless they can get between, $3.50 and $4 a square foot in Oakland and $5 a square foot in San Francisco. And there's only so many parcels where you can make that.
Well, so if I could challenge you, the question, as I understood it, was, is this impossible in the sense of, is it impossible to create new policy that makes it possible?
I'm just saying.
But I'd be remiss.
Today,
But I'd be remiss in not saying this as a banker. We are in a very favorable interest rate environment. The idea that a 4.5% or 5% rate is a high rate is stunning to me, having been in this business for 2 decades. And I'm still surprised the Fed hasn't got more aggressive with respect to raising rates. I think you might see that change after the election. And I do think as economically, challenging as it is when we're looking at rates in the 3 and 4% range, it's going to be exacerbated if rates go up because, we've got to service a debt at a 5 and 6% rate. We have a whole generation of folks who think a 3.5% mortgage is, normal, and if rates, if and when rates move up, I think it could exacerbate that.
And don't misinterpret my comments. I'm basically saying, I'm optimistic that the kind of solutions you've put up there are the right solutions, but we need a lot of other interventions in order to make that happen, right?
And as a policymaker, first off, I want to be able to identify the problem and then figure out what the things are that we can do that help solve that problem. So that's why I asked my question. I'd be very despondent to hear that we've got this issue and we just can't do anything about it. For me, the more frustrating issue, notwithstanding, I get the seriousness of the observations you made, Carol. But on the transportation side, the timelines for getting things done. If you think it's bad in developing real estate, for getting a project built in the transportation world is just ridiculous. There's it's not news to anybody, but there's an article in the Times today about Measure M and the reduction that is predicted of 15% reduction in traffic, which I frankly don't think should be the focus anyway. But that 15% doesn't come until 2050. That's when these projects are fully built out. That's like crazy time frames for, at least for most of us. Even for millennials, that's a crazy time frame. And a lot of that is due to the fact that our planning is, the timelines are just ridiculously long, and we need to do something about that. And then the second thing on transportation that frustrates me is that because we haven't had and this is a whole other issue, but because we haven't had a robust public transit system in Southern California for so long, we've been focused on the region writ large, and so our projects tend to be these very large mega projects, and we've ignored the kind of streetcar type transportation solutions that you see in successful community after economically successful community across the country and across the world, and we're not doing that in Los Angeles. So we're in California.
I'm going to go to the audience just in a second, so I'm sure that people have questions. But what I'm taking away is that while technically this might be possible, the rules of the game as they are today make it economically very challenging for much of this to happen. And so it is time perhaps to reevaluate those rules and say what changes to those rules would make it possible for the economics to work and to deliver this, as if we all want it to be delivered. So that's the conversation. And
can I make one other comment? I think it's not just the rules of the game. I want to put something back on the private sector here. Some of these costs, hard costs of construction, I do think, we've been building homes the same goddamn way we've been building them for 100 years. There's not huge amounts of innovation, and everything else is innovated around us. And I think, I'm working on some ideas, and I know other builders are too, but I think we need to also think what the private sector can do here to lower their cost of production.
Well, and I think there's no choice on that end, so we are working on the initiatives. In fact, Jonathan talks about the panel build. We're going to be doing that in Highland Park, and there's an efficiency to that. And the innovation, yes, the homes still have gas and windows and doors and a garage. Not much has unfortunately changed compared to other industries. I will tell you, what you show here, we're doing all of it. So it's just, I don't do enough of it. Yeah. I'm like a little pea in the pond in all this. And at the end of the day, except for the add units to existing, we've got a project where you have develop affordable and adjacent single family housing. We're working with Supervisor Mark Ridley Thomas, and we're in between Gardena and Compton. We're entitling a project right now which will have 94 detached homes, 60 of them will be market rate, 34 will be low to moderate income. These starting prices are detached homes in a gated community, 3-bedroom, 2-bath, $70,000. 3-bedroom, 2-bath, detached home, driveway and yard. And I told the supervisor, let's go do 10,000 of these. I opened up in Gardena. Gardena is feeding off of all of the lack of affordability in the South Bay and LA. I opened up with 42 townhomes, 3-story townhomes. And that happened because that was a buy right, but you need buy right with council support. So we actually got denied at Planning Commission and council approved us. We happen to be buying the property from the city as well. But Gardena sold out. We're looking to do another 120 in Gardena. The challenge is Gardena is $500,000. Gardena 3 or 4 years ago, that same exact unit would probably be $385,000. Pricing is running up so quick. We have to act very fast. We're getting so much later in the cycle, and the market is good. That is one thing I don't think should be ignored. We're in a very healthy market, particularly along the coast. There is incredible demand, but it's partly demand for the wrong reasons because there's just not enough supply. So what's out there is being driven up, and it's because a lot of these cities are very late to the game. Some do not want new housing. Some do not want affordable housing, and it's a self-fulfilling prophecy. Yeah. So we just see prices in Northern California. I mean, it's shocking to me. When you look at San Francisco, which I think is starting to stabilize, it's hitting a peak here. Mm-hmm. You know, there will be a change, there will be a recession, there always is. I don't know when that will be, but at some point there will be something that occurs in this market to drive back affordability to moving up, because we're getting close to that 30% threshold, and many areas are dropping below it, where you're getting to 20%, and some areas are in the teens now for affordability. And that pool of buyers is shrinking, and at some point here, because the financing is not gonna change that much, people just aren't gonna show up.
I'm going to ask for questions from the audience. There's a microphone right over here, if anybody wants it. Yes, right over there.
Could you address the impact of interest group politics? You mentioned the costs of construction. I'm an apartment developer in Indiana. I don't have anything happily in California, but I live here. And the union domination in many ways is driving up the costs that you addressed, Scott, but you also have other interest groups that are also driving up costs, the impact fees, and the thirst of local governments for impact fees is in school districts is tremendous. And we all want affordable housing, but when you got the costs going so high, it's just not possible. Can you address that?
Yeah, so it's, and Carol and I talked about this earlier, it's hitting us from all sides. And again, you know, you talk about us having a modest profit. We're going to make a profit. Otherwise, our view is we'll have a smaller company. I look at what we do. I always say it's doing good things for selfish reasons. We are a for-profit company. I think what needs to be understood in that is we have capital partners. And this is a very limiting factor to everything that you talk about, Jonathan. So many private developers, and I'm always very candid and open, so ask me whatever you'd like, our deals are 80-20s. So we're putting up 20% of the capital. So if we're doing a deal at $30 million, we have to write a check for $6 million. Very few private companies are willing to write a check for $6 million. The capital today used to allow a co-invest. So that $6 million, Jonathan would give me the $6 million, and really I'm not putting in any money, which we would never do. So it's very limiting now. You have no co-invest and you have a higher, the 20%, a lot of people were used to 5%, 10%, 15, whatever it is. You have to put in 20. We feel good putting in 20 because we'll do our projects with or without private equity. But private equity today is seeing margin compression. So the margins are getting tighter and tighter as all these costs continue to go up. They are not as interested in investing in multifamily today or residential. So the game is changing. And at a state level, we talked about the labor side. Again, not to keep going back to Jonathan's report, but I think it's an interesting playbook for what's happening out there. We don't have enough people to build houses, so we're not building enough houses. We don't have enough people to build them. The leverage is with the trades today. The leverage is with the consultants. And the builders always do it to themselves, the developers, because I just paid you an extra $2,000 to frame my house because I had to get it done at the end of the year. Well, that's the new rate now for you to frame my house. The consultants, we just rush to get something in, and with the neighborhood integrity, and really it's the Build a Better LA, there has been a flurry of submittals in the city of LA that I bet they have not seen in their 150 years of existence. I mean, there are people lined up trying to get those plans in to get them deemed complete on their submittals so that they're not going to be impacted by that. So there's a lot going on, but what you're talking about, unfortunately, I don't think there is one fix, and maybe Jonathan has one that's going to bring down all those costs.
I would just say, I think you've just hit on, if you just had what it costs, land, every element of construction, every fee, and you line it up, we've got to take the pin out on every one of these things and shave some money out of the system. On the impact fees, I would just want to make a point that I think your report says this well. Impact fees are all over the map, right? It could cost you $100,000 a unit before land, before anything, in say the city of Fremont, and it could cost you, $20,000 somewhere else, and that's before you get into schools, et cetera. So could the state set some standards and say, we have nexus studies for how much affordable, you got to prove that there's a nexus to do inclusionary zoning. What about the nexus of what the impact fee is on a detailed basis? Why does it cost this school district, more money than that school district to build a school? Why should we not have more standardized fees at the local level? And I think the state could do something about that in terms of setting the stage. And
I think absolutely. This theme of government productivity is one of this vast pools of capital gets spent. Sort of how, where, why is it? How well is it being spent? Why do people? How do we set targets? That's clearly an opportunity. And yeah, we also look at the productivity side on the building side as well, saying maybe this is the moment where we start to really see some kind of development on the construction business model, that it moves from this highly bespoke, very labor-intensive, very one-off kind of projects to something more productive, something that drives productivity. Maybe it starts to look a little bit more like manufacturing.
Well, I actually think that it's going to start looking like that. And there was a recent builder-developer panel that I was at, and they were talking about the recyclable house and buildings, where they're now looking at the upfront cost. If you're using recyclable materials, you need to bake that into your pro forma and your cash flow, because there is an end use. And we have got to become, I completely agree with you, more cost. Something's going to break here. And the interesting thing is the economy is still very good. The demand is still very good where we're building.
Yeah.
But due to where the pricing is, we can't build. And so something's going to move. The biggest factor I think that will need to change, the land side is escalated at such a fast pace. And Richard hit on something very important. And when you're an urban infill, there's optionality. So they don't just have to go residential. I think that Whole Foods scenario is something we all faced. We had a tremendous amount of multifamily competition. I mean, that's who showed up and bought the majority of the land. That isn't as strong today and is going away. So the world changes, but that is one of the challenges. In most of the land that is held in these urban areas, there's a strong value and there's staying power. So the majority of the people that own these properties have owned them for a long time, and they're not just looking to sell them immediately or sell them at what they perceive may be a discount.
Yeah. Time for one more question. We got one right back there. Yep.
Hi, I'm Kristen Pauling with the Natural Resources Defense Council, and I wanted to pick up on the point of that ADU bill not being really a small thing. It's a very big thing, and to Carol's point of pulling out all the pins, one of the assumptions that we were talking about is parking for housing and the cost of parking. If you build that high rise in Oakland and plop it in downtown LA, you're going to dig really far to build enough parking, and that's probably the cost of that 70,000 unit that you're building in Gardena is the same cost as parking. Are there solutions? Is the lending community thinking about, are we okay with selling and financing without building parking, especially as we've been working with cities across the country on smart cities, autonomous vehicles? Do we need parking anymore? And is the lending community interested in experimenting on that?
Well, we're certainly not going to experiment unless we get proper permits. And so, if you build a building without parking and it can't get permitted, you're not going to see much lending interest other than maybe very, very non-regulated financial companies that are going to charge extremely high rates. And so, certainly from a lender's perspective, we're going to be looking towards policymakers, probably driven through the construction firms to drive that change. It's really hard for us to do that given the regulations we're subject to sort of be on the leading edge of that. We're sort of the tail, if you will, and it's hard for the tail to wag the dog on something like that, unfortunately.
What do you think?
Well, this is something that local governments can control, but residents are driven by two great fears of traffic and fears of not being able to find a parking place. And when you start talking about reducing parking in projects, folks start to get worried that they're not going to be able, on already crowded streets, to be able to find that parking. There's a disconnect between that very legitimate public policy and the environmental benefit from that and the benefit to development that people don't yet see. And we as policymakers, as leaders, need to do a better job of explaining that to the public, but we should be doing it.
Yeah, I would just say, I think it's starting to happen. I mean, I've got this little calculator that I'm not going to show that does show, like, if you're taking some of these pins, the different costs of things, and, the parking at 40 or 50 grand a unit is a lot of money. So I think it is starting to change for some localities. I think Oakland just passed in their downtown core near transit, lowering parking requirements. One of the questions is going to be is whether developers and banks will, go with that because they're concerned about the market. And I think that's going to take, I'll just give you one story. I had a market rate developer come speak to my real estate development class, and he asked, so if we reduce parking and, how many people here have a car? Or don't have a car, and of course, 70 people in the class all raised their hands. None of them have cars, so this would be great for them. And you could tell the developer was kind of taken aback because that's not who they're used to marketing to, and so they would be reticent even if a locality has a lower parking requirement.
Carol, one thing that's important on that, so I battle parking. I'd like to get your card because you can come with me to City Council. I have a hard time doing a tandem garage and fighting with cities on that. They all want two cars side by side, and they use it as a mechanism to control density.
Yeah.
That's in either they're trying to push you too far up or too far down. They don't want it. And our buyers, people always say to us, and our investors go right along on this, is on the tandem. Just to wrap this up, the buyers are more than willing to have tandem. There is no huge discount to tandem. And not everybody has two cars, but that is a big battle.
Yeah. Yeah, well, I know we need to conclude, but I do think trying to demonstrate that we have a market that will, really accept it, and I don't know that we've all done enough work on that to prove to the policymakers, that this is an accepted, and the lenders that this is an accepted product.
We could literally, I'm sure, spend the rest of today, but this is actually a hopeful note to conclude on, so I want to thank the panel very much.
Thank you.